Yeah, Kyle, as always, great market updates, great job, and another exciting week of security token trading. And as you mentioned, Mount Pelerin has been skyrocketing. BCAP seems to be trying to align more with its NAV, so it'll be really interesting to see if it moves closer and what happens. And in the meantime, be sure to head to stomarket.com to view all the live trading data. But now I think it's time to transition into the main topic. Ready to dive in, Kyle?
Yeah, let's do it. So today we're going to be diving into the different methods of distribution for a security token offering. When we're talking about a security token offering, we're specifically discussing real world assets that are owned by real people or companies. This could include equity in a company, it could be real estate, a debt product, or any other asset that an investor might want to buy. And as we've covered on the show before, the reality is that with security tokens, you must comply with all of the established laws and regulations around fundraising for that investment. That means that you need to identify every investor that you bring on, as well as ensuring that you follow anti-money laundering laws to prevent criminal activity. On top of that, you need to follow all the local rules too, which means that you might require additional verification like accreditation here in the US. And one final note before we dive into the real meat of the segment here is that neither Jonah nor I are broker dealers or licensed financial advisors. None of this is legal or financial advice, and all of this is just our opinions based on independent research and collaboration with many of the players in the industry. So with all that out of the way, it's time to dive in. Jonah, how about you break it down for me? If a company is looking to launch a security token offering here in the US, what are their first steps for the fundraise?
Well, Kyle, that's definitely a loaded question because there are many steps in the diligence process that must be solidified before a company should consider a fundraise. Once they've moved into distributing their offering, a company has strategies that can leverage itself in addition to many different vendors who can assist with this process. For starters, the type of fundraising exemption a company is using plays a huge role in how a firm conducts its raise. Reg D 506C and regulation crowdfunding are the two most common fundraising exemptions, but have very, very different processes. Since a Reg CF deal allows retail investment, an issuer needs to work directly with a licensed crowdfunding portal who maintains a diligence standard.
So let me explain the regulation crowdfunding piece that you brought up for those who maybe aren't familiar. The Reg CF process is kind of like a Kickstarter listing where a company creates a listing page and explains the business model, creates the marketing campaign, and includes the documents of incorporation and other metrics to help an investor evaluate the deal. These crowdfunding portals, like my company of the week, Republic, assist in creating more visibility for the listing through its email list, search algorithms, and consistent traffic of hundreds of thousands of website views per month.
Exactly, right on the head, Kyle. In exchange for listing on the platform, an issuer has to pay a flat rate fee in addition to a percentage of the total fundraise. However, RegCF has a significant restriction with its cap of just $5 million per year. So if a company is raising over that limit, they'll have to use a different exemption to get it done completely. On the contrary, in a Reg D offering, which is the most common exemption used for private financing, there is no cap on how much an issuer can raise, and there's no requirement to work with the fundraising portal. So it can offer more flexibility during the fundraising process. However, with Reg D, there are still integral vendors who can assist in the fundraising process. Traditional broker dealers like Triturian Capital or eToro provide value to larger deals by connecting the company with a network of investors who are actively investing in that specific vertical. Raising money can be an incredibly difficult process for smaller businesses or companies in smaller financial markets, so brokers provide a crucial service to help connect interested investors with projects they care about. All brokers charge a fee based on how much they're able to raise, with a rate usually between 2 to 8% of the total raise.
Exactly. We've also seen some very successful examples from a fundraising perspective internationally, with Stalker and Black Manta Capital Partners both being very successful working with security token issuers and assisting them in the fundraising process. And from a terminology perspective, it is important to note that broker dealers that you might work with don't technically underwrite the deal. In an underwritten deal, the bank that you're working with would actually commit to purchase all of the shares that go unsold during that fundraise process. This gives the issuer a commitment that they've actually secured the funds, but it does allow the bank to adjust the price based off of the demand for the product. In a private fundraise, while the broker can directly invest in the offering on its own behalf, it's much more common to see them just aim to sell as much of the allocation as possible for their clients and then receiving commission on their performance. What other distribution strategies would a firm seek to leverage during its fundraise, Jonah, aside from those?
Yeah, well, another very successful fundraising strategy employed by AngelList and others is to create a private angel syndicates to directly invest into deals. The way this works is that AngelList has created a platform that facilitates the collection of many individual investors that are represented underneath one fund. These fund vehicles are led by what they call syndicate leads, including notable investors like Jason Calacanis, Tim Ferriss, and others who are essentially raise funds on platforms alongside smaller investors. In this way, lesser experienced investors can pool cash together to get access or better allocations in a deal by investing alongside their experienced investment lead. These aggregators were actually given a no action letter by the SEC, indicating that it did not deem the actions on behalf of the aggregators themselves to be broker-dealer activities, as they do not have as much control over where the syndicate invests and do not collect fundraising fees that brokers would charge to the issuer. Instead, angel syndicates charge money to the investors for the access to deals, as it is structured as a percentage of the total assets under management and a percentage of the carry or the profits that the funds makes over time. These funds can provide great access to capital, but these funds tend to be more targeted based on the specific lead's venture expertise.
So, private syndicates have been very successful in the startup and real estate world, and it's not much different from investing in a fund as a traditional LP. Angel syndicates don't need to come through a platform like AngelList, though, so it is pretty common to see angels that just band together on their own to invest on behalf of their group in a deal. The main benefits from angel syndicates are that they typically find value add or strategic investors in addition to just being able to manage more personal relationships with your direct investors.
Finally, Kyle, we have the issuer managed distribution through Reg D 506C. With the codification of the Jobs Act, issuers for the first time to generally solicit their deals to the public. Prior to 2012, a private business really had to be private about their fundraise and couldn't be allowed to attract new investors. They were forced to rely on their network. With the addition of 506C, companies are able to take matters in their own hands, and they could potentially even do a Super Bowl ad, which would be pretty interesting to see.
Yeah, they absolutely could. I mean, with 506C, a company can now create its own organic content to drive investment. They can discuss the raise publicly and pursue interested investors from their public network. In addition, marketing and advertising platforms also have sprung up, which assists in boosting the company's exposure as much as possible for a flat rate instead of a performance fee. Media firms have been able to offer significant benefits to the fundraising businesses who are now more interested in just driving the most traffic and awareness to the deal as possible. And then advertising models can be just as effective as broker-dealer relationships, especially when you're talking about niche industries and markets.
The reality is that a firm will likely use a combination of some or all these methods in order to complete their security token offering. With the ability to market and advertise their deal to the general public, it opens many doors for issuers to create strong marketing campaigns to drive traffic to their platform. However, since Reg D requires accreditation, they likely will be working with a platform that can onboard and verify investors, which often has a coincided broker platform to assist in that fundraise process.
Yeah, you're absolutely right. I really just couldn't have said it better myself. And because of that, I think it's a great summary of the different distribution channels that a firm can leverage when it comes to a security token offering. Is there anything else from your end, Jonah?
Not much. Just, it was an honor to be on the show. I think it's a great place to call it. I hope you enjoyed today's episode. Please send in any questions or feedback to us on Twitter or LinkedIn. And be sure to get the latest trading data and news at stomarket.com. And of course, this Thursday on Clubhouse, be sure to catch the breakdown of this podcast like we do every week.
You got to tune in. It's a blast. Either way, I'll catch you next week on Tuesday for episode 87.